Today, one of the biggest tech names, Google, dropped 7.5%. Have a look at this daily chart over here. When I zoom in, you can see that yesterday the closing price was at 107.64, and today the closing price was at 99.37. In fact, it went all the way down to 98.03. So that's a massive move downwards. What caused it? Well, they had an AI event. Basically, they introduced to the investors their new AI tool, and the investors didn't like it that much. But I reckon this is a absolutely ridiculous reaction to the event, and I am betting big time on a bounce back, potentially as soon as tomorrow. So what did I do? What is it that you can do in these sort of situations when you see a big drop or a big spike and you don't think that it's justified? Let me show you right now. So this is my trade number 240. For those of you who are new to my channel, this is my daily trade log. I document one of my option trades every single day for your benefit, so you can learn from it. You can learn how to trade options. But let's go back into my trade number 240, Google. And like I said, I am very bullish on this one. So what I did is the February 10 expiration has a volatility of 53.2%, and I sold the 107 call option, which was trading much higher when I sold it, and I purchased the June 100 call option. So the deal cost me $8. Now, if we look at what's happening after the close today, the price have gone up already a little bit. So it closed at 99.37, but now it's trading at 99.43. So if it continues going up, then the value of this diagonal trade that I purchased is going to keep going up. At the moment, the mid price, as you can see, is at $8.55. I purchased it at $8. And let me show you the analysis of this particular trade. And let me give you a little background as to how diagonal trades work and what it is. So a diagonal trade is similar to a calendar spread where you're trying to take advantage of the bigger volatility of options expiring sooner versus expiring later. But with diagonal spreads, what you do is, instead of using the same strike price as in case of the calendar spreads, you use different strike price. So I sold the 107 call option and I purchased the 100 call option. And this diagram over here shows the potential return on the 17th of February. So if I hold this position till the end of next week and the price bounces back up to 107, then this particular deal could potentially generate close to $500 return. I invested $800 and I could potentially walk away with $1,300 within just over a week. So that's a tremendous return. Now, what happens if it doesn't work out? Then I still have till June to be right by rolling my position, by rolling my short position, the one that expires in 2 days. So this is what the potential return of a diagonal spread looks like. It's a risk-defined strategy. My maximum loss is $800. That's how much I invested into this deal. But I know for a fact that I will not lose $800 because of what I mentioned previously, that if things work against me, if the price works against me, then I will be able to roll my short position to, let's say, February 17, and then from there I can roll it to March 17, April, May. So I've got several months before I reach the June 16 expiration. So every single time I roll my short position, I collect additional credits, and those credits reduce the amount of money that I have invested in this deal. Let's assume that I need to roll my February 10 position on Friday to, let's say, February 17, and I collect 50 cents credit for it. Then the invested money that I have in this deal goes down from $8 to $7.50, or in other words, in cash terms, it goes from $800 to $750. Just a reminder, when we're talking about options, you always have to multiply the figures by 100 because every single option covers 100 stocks. So this is how diagonal spreads work. I hope it makes sense. And what I'm hoping even more is that the price is going to bounce back up all the way to 107 and I'll be able to make a tremendous profit on this. Just for your interest, let me show you what the payout would look like. Let's say on Friday, if the price bounces back up to 107, then I would still be able to make about close to $400 on this deal within pretty much a day or two. So I hope you enjoyed this. I hope you find it inspirational. If you like this video, please hit the like button, subscribe to my channel, and I'll see you on the next video. But before I wrap up, just a reminder that I only have 7 more trades to go to complete 1 full year of my daily trade log series. And after I completed my 12 months, then I will share my results. I will show you how many trades I made, how many were successful, what were the results, what were the returns, what was the total amount I had to invest. And you will get all that insight, all that information, and then you can judge whether the strategies that I like to apply work or not. So I'll wrap it up for today. Thank you for watching. Have a great one.